So we'll now look at the tax effect accounting concepts. So accounting profit and taxable income are two different amounts, and you need to account for the current and future tax consequences of tax in your financial statements. The relevant accounting standard to refer to is AASB 112, and is a useful standard to refer to if you have any tax effect accounting issues. So this is our normal steps when we perform tax effect accounting. We will roll over our prior year balances, our prior calculations, and calculate our under and over provisioning of tax. And this is referred to as a true-up entry. In the second step, we'll prepare our statement of taxable income and calculate our current tax. In the next step, we'll compare our accounting balance sheet to our tax balance sheet and calculate our temporary differences and deferred tax balances. From there, we can determine our income tax expense, and finally, we'll work out our journals and our disclosure note for the financial statements. The simplest is your current tax expense, which is the tax that you pay to the ATO for the current year. So broadly, what it is simply your taxable income multiplied by your current tax rate, as simple as that. So taxable income multiplied by 30%. If you're a standalone entity and you are in losses, your current tax expense is obviously zero because you don't have any taxes to pay to the ATO. However, if you are a subsidiary of a tax consolidated group, and if you are in losses, sometimes you have a negative current tax expense. The reason is because you are part of a tax consolidated group, and the consolidated group might be in a taxable income position. And if you are a CTS user, a CTS software user, the calculation of CTE takes into account whether or not you're part of a tax consolidated group. So this is a journal that you post for current tax expense. You debit your current tax expense, and you credit your current tax liability or your provision of income tax account. Now, often many companies do not break up income tax expense to the three components in their trial balance. That is fine. Everything can be journaled to the income tax expense account. However, when you come to prepare your disclosure note, you do need to break it up to the various components. Now, the next component of income tax expense is your under and over provisioning of tax. And there seems to be different treatment in practice. Put it simply, your under and over provision is basically a change in your current tax expense between the time where you perform your tax provision calculations and when you prepare your tax return calculation. There must be a change in taxable income between those two calculations, okay? Now, if, for example, your taxable income has remained unchanged, however, you chose to restate your deferred tax asset or deferred tax liability balance, that restatement is not an under and over provision because there's no change in taxable income. So that restatement simply goes through the deferred tax expense in the current year. So the next one is the final component of tax expense is your deferred tax expense. So deferred tax expense is simply this. You take your opening net deferred tax asset and liabilities, take your closing net deferred tax asset and liabilities, the change from opening to closing, if you take out the equity accounted entries, and we'll look at what that is, that change from opening to closing is your deferred tax expense. So to work out your deferred tax expense, you need to calculate your deferred tax asset and liability balances. So the next, what we're going to do is discuss the calculations of deferred tax assets and liabilities. So in order to calculate your DTAs and DTLs, you start with your trial balance. Your trial balance will contain the carrying amount of your assets and liabilities. For each asset and liability, you need to compare it to their tax base. and the difference will give you the temporary difference. So the carrying amount is whatever you have in your trial balance, the book value or accounting value. Now you note that you need to put through all your accounting standard changes. For example, putting through your right of use asset additions, and you need to put through any impairments or revaluations before you do your tax calculations. So tax is the final adjustment. You then need to calculate the tax base of each asset and liability. So broadly speaking, the tax base of the asset and liability should broadly reflect your understanding of what their values are for tax purposes. So let's have a look at that, and I'll come back to CGT asset because it's slightly different. If you have a depreciating asset, your plant and equipment like your computers and your furniture, the tax base should equal the tax written down values of those assets and liabilities. For trading stock, it will be the tax value for tax purposes. Broadly, it will be the tax cost of your inventories. For liabilities, it depends on whether or not when you pay that liability, it will give rise to a deduction. So, for example, if you repay a bank loan, a trade creditor, or an intercompany loan, the payment of that liability does not give rise to a deduction. So in that scenario, the tax base of that liability will equal the carrying amount. So no different from what you have in your trial balance. Now, certain liabilities, you get a deduction when you pay it out. For example, an annual leave provision or a superannuation accrual or audit fee accrual. In that situation, the tax base of that liability would be 0. Now, I'll come back to the tax base of a CGT asset, because it depends on whether you are holding the asset for use, that means you're using it to generate sales or services income, or you're holding an asset for sale. Now, the two common areas that could give rise to errors, one is intangibles. So let's say you acquire trademarks or brand names or customer contracts or customer relationships. Those assets are generally regarded as being held for use to generate sales income. So when you're holding an asset for use, the tax base will equal the future depreciation that you are going to get on those assets. So things like trademarks, brand names, copyrights, customer contracts, they are not depreciable for tax purposes. So there'll be no depreciation allowed when you use those assets, so their tax base would be 0. The same with buildings as well. If you have a building and you are depreciating that building for accounting purposes, there is a rebuttable presumption that the asset will be held for use. That means the tax base will equal the future Division 43 deductions that you're going to get from that building. Now, if you have something like land, for example, it may be regarded as being held for sale. So in that case, the tax base should equal the cost base, because you can deduct the cost base against the sales proceeds there. So that's something to be careful of when determining the tax base of CGT assets. Now, if you like, you can use these formulas here to calculate the tax base of your assets and liabilities. For the tax base of an asset, you start with the carrying amount, and then you minus the future assessable amount from the use or sale of that asset. And AASB 112 says the future assessable amount will always equal the carrying amount. So you can make that assumption. And then you add the future deduction that you'll get from those assets. For the tax base of the liability, you start with whatever you have on your trial balance, and then you subtract the future deduction that you're going to get when you pay out that liability. And you can also see calculations, the formulas for prepaid expenses and prepaid income. So let's look at a simple example in relation to two liabilities. One is a provision for annual leave of 100,000, and the other is a provision for environmental fine of 200,000. So the annual leave provision, like I say, you start with the carrying amount, and then you subtract the future deduction that you're going to get when you pay out that liability. So you get a deduction for 100,000 as well. So the tax base is 0. In relation to the provision for fines, the carrying amount of 200,000, and because fines are not deductible, you do not get a deduction when you pay out that provision. So it's 0 in terms of future deductible amounts, and the tax base is 200,000. So the message here is that just because you call something a provision or an accrual does not mean that the tax base is 0. The next question that you need to deal with is whether or not you can or need to recognize a DTA, deferred tax asset, or DTL, deferred tax liability, on those temporary differences. Now, in order to do so, you need to consider the recognition criteria and recognition exceptions. And if you can recognize those, or you must recognize those temporary differences, you multiply the temporary difference by the company tax rate to derive your deferred tax asset and deferred tax liability. Just got a question from Connie. Yes, we will make this recording available after the presentation. Okay, so in deciding whether or not you need to recognize a DTL or can recognize a DTA, for a taxable temporary difference, a temporary difference that increases your tax in the future, you must recognize a DTL for them, unless a recognition exception applies. For DTA, for a deferred tax asset, those things that reduces your tax in the future, not only do you need to consider the recognition exception, you need to demonstrate that it is probable that you're gonna use those future deductions or future revenue losses. And we'll look at this probable criteria shortly. In relation to capital losses, it's a little bit more difficult to demonstrate that it is probable that you're gonna use those capital losses. You need to show two things. One is there's something on your balance sheet that you're gonna dispose of for a capital gain enough to absorb those capital losses. And two, you intend to dispose of that asset in the foreseeable future. So that's a more, I guess, difficult criteria to satisfy. So in order to demonstrate that it is probable that you'll use the temporary differences and revenue losses, you need to demonstrate that it's more than a 50% chance that you'll use those deductions and losses. So there's no set rules of how much more. It could be 50.1% or it could be 70%. You can determine that number based on your internal policies. So in working out whether it's probable that you're going to use those deductions and losses, you need to put your positive evidence beside your negative evidences. So your negative evidence might be, for example, you got a history of tax losses being incurred. So that's strong. That's a very strong negative evidence. Your positive evidences might be, for example, you acquired a business that is generating income, or if the economic situation has changed, or you have come out from the I guess a startup period. So you compare the two and decide whether or not you satisfy the more likely than not criteria. Also, you can recognize an amount of deferred tax asset to offset any DTLs that you are required to recognize. So there are two common questions which we get. For example, one is that let's say you have impaired an asset on your balance sheet. Can you recognize a DTA on those unrealized capital losses? So you need to apply the same criteria as capital losses. You need to show that you have an asset that you can dispose for a gain, and you intend to dispose it in the foreseeable future. Another question that we get is, I have to recognize the DTL, but I don't recognize any deferred tax assets. Now, is that the situation? So as I said, you can recognize enough deferred tax asset to offset any DTLs, deferred tax liabilities you have. So you end up with a net DTL of 0. Okay, so I referred to recognition exceptions. So this is what we're going to go through now. There are 3 recognition exceptions. So if you have a temporary difference, you need to determine whether or not a recognition exception applies. If the recognition exceptions apply, you do not need to recognize a DTA or DTL on that temporary difference. So the first one is goodwill. It's easy. If you see goodwill, do not recognize anything for it. The other 2 recognition exceptions are the initial recognition exception and the one relating to investments in your associates and subsidiaries. So we'll look at the initial recognition exception first. So it obviously does not apply to investments because there's one specifically for them. The initial recognition exception says, do not recognize a DTA or DTL if the transaction is not a purchase of a business or an entity with a business, and at the time of the transaction, there is no impact on accounting and taxable profits. So at the time of that transaction purchase. And this is the new addition that has been put in to AASB 112. At the time of the transaction, you do not recognize the same DTL with an offsetting DTA with an offsetting DTL. And the purpose of this addition is basically to clarify that the initial recognition exception does not apply to right of use assets. So when you have a right of use asset, you have a DTA and a DTL being recognized at the same time. So let's look at a simple example. You acquire a luxury car for 200,000, and the tax base of a depreciating asset, as I mentioned, will equal the tax written down value. And cars are subjected to a car limit. I have 57,581 there. That number has changed. The difference between the 257 is 142,000. So by virtue of buying that luxury car, you have triggered a taxable difference of 142,000. The question is, do you need to recognize a deferred tax liability on that taxable temporary difference? So let's go through the criteria. When you bought that car, were you buying a business or an entity with a business? The answer is no, so I can tick that. At the time of the transaction, was there an impact on accounting profit and taxable income? The answer is no, because it's a balance sheet entry, so I tick that. So the initial recognition exception applies. Although you have a taxable temporary difference, you do not need to recognize a deferred tax liability on it. However, in your financial statements, you do need to disclose all your temporary differences, which you do not recognize a deferred tax balance. So the next one is investment in subsidiaries, branches, associates, and joint ventures. So temporary differences can arise at the consolidation level or at the parent entity accounts level. The exception says that you do not need to recognize a deferred tax liability for the associate or for the subsidiary if the carrying amount differs from the tax base. If you can show that you control the dividend policies of the investee, and you control when you choose to dispose of that investment. And secondly, it is unlikely that you're gonna receive an unfranked dividend, or you're gonna sell that investment in the foreseeable future for a gain. In terms of a DTA, a deferred tax asset, that means you have an unrealized capital loss. The same criteria as I mentioned earlier would apply. So finally, disclosures. So AASB 112 requires certain disclosures to be made in your financial statements. The key one being that you do need to break up your income tax expense to its various components. Secondly, you need to provide reconciliation. You start with your accounting profit multiplied by your corporate tax rate, and then you need to show all the adjustments, which brings that amount to your income tax expense number. You also need to provide a breakdown of your deferred tax asset and liability balances. Okay, now we'll go through some of the more complicated topics, and we'll start with equity accounted entries. So AASB 112, to put it into context, says that when you recognize a deferred tax asset or liability, you need to refer to and follow the original accounting entry, which gave rise to the temporary difference. And you will note that you have certain accounting entries which you post against the equity section of your balance sheet. And some of the examples are you might revalue an asset, or when you apply a new accounting policy or accounting standard, you might make an adjustment to your opening balances against your retained earnings. And two common ones which I also see includes when you apply H accounting, or you are accounting for defined benefit plans. So let's look at an example to clarify that adjustment. And let's look at a situation where you revalue an asset. So let's say you have a plant. You have a plant equipment which costs 10,000. So the tax base equals 10,000. And let's say, for simplicity, you immediately revalue it by $6,000. That revaluation does not change the tax base of an asset. Therefore, you have a carrying amount of 16,000 and a tax base of 10,000, giving rise to a taxable temporary difference of $6,000, which means that you have a deferred tax liability of 6,000 times 30% of 1,800. So you know that you're going to credit your deferred tax liability by 1,800. The question is, what do you debit? Which account do you debit? So in order to work out which account you need to debit, you need to refer to the original accounting entry. So to revalue the asset, you debited the asset by $6,000 and you credit the asset revaluation reserve. So following the original entry, when you credit your deferred tax liability, you need to debit the asset revaluation account by the 1,800. Now, to give you a further example, if you depreciate that plant, right? If you depreciate that equipment, over time, you'll find that your deferred tax liability would reduce. So you need to debit the deferred tax liability balance. The question is, which account do you credit? The answer is you need to credit your income tax or deferred tax expense account. Why? Because accounting depreciation is going against the profit and loss statement. So what that means is whatever is sitting in your asset valuation reserves stays there. And then when you dispose of that asset, you simply move the entire revaluation reserve to the capital profits reserve or the retained profits. Okay, the next one is business combinations. And to put it into context, this is relevant when you are performing your financial consolidation. Remember, when you perform your financial consolidation, you're bringing assets in at their fair values. And it might differ to the tax cost of the assets and liabilities for tax purposes, giving rise to a temporary difference. So as I mentioned, DTA and DTL, due to financial consolidation, may differ between the economic entity and the entity owning that asset. So that may arise because of the fair value adjustments to those assets and liabilities. Tax consolidation might affect the tax cost of the assets as well. And the standard says, if you have to recognize any additional deferred tax asset and liability, the other side of the entry goes against goodwill. So let's have a look at a simple example. So we have company A acquiring a target entity, company B, for $1 million. And in company B, let's say the assets comprise of stock of 500,000 in the accounts, and that's what the cost is for tax purposes. But company A says, well, the fair value of the stock is really 400,000, less than what's in company B's accounts. Company B also has an annual leave provision of 50,000, and naturally company B will recognize a deferred tax asset on that provision of $15,000. So let's calculate the goodwill. So company A paid 1 million minus the net asset being the fair value of the stock, add the deferred tax asset minus the provision for annual leave, gives rise to a goodwill of 635,000. Now you note that company B has a DTA of 15,000 on the annual leave provision. However, at the economic entity level, let's ignore tax consolidation at the moment, the economic entity has two future deductions. One being the annual leave provision, and two being the fact that the fair value of stock is less than the tax cost of 500,000. So there's an additional deferred tax asset of 30,000 on stock. So what does the journal entry look like? This is an initial elimination entry before we apply AASB 112, and this is after. So here we bring in the assets at fair value, 400,000 stock, DTA of 15,000, annual leave liability at 50,000. We eliminate the investment, and we bring in goodwill of 635,000 in the economic entity accounts. However, the economic entity will recognize an additional 30,000 deferred tax asset on the stock. Therefore, its DTA is 45,000, and the other side of the entry will go against a credit to goodwill. Okay. And in your notes to financial statements, you need to show the portion of the change in DTA that is going against goodwill. Okay, so now we'll look at the accounting for tax consolidated groups. So the relevant pronouncement will be UIG 1052, which requires subsidiaries to record their tax effect accounting entries, regardless of whether a tax funding agreement is in place. So we'll discuss what that is. So what that means is that each and every entity in your tax consolidated group should be preparing their own tax effect accounting calculation. You then work out where the current and deferred tax balances needs to sit. So under UIG 1052, when you're doing the calculations for the head company, it will recognize its own current tax liability. It will recognize its own deferred tax asset and liability for its temporary differences, and it will recognize its own deferred tax asset for its tax losses and tax credit. When you come to perform a calculation for a subsidiary member, the subsidiary will initially calculate and recognize its current tax liability, but UIG 1052 requires that amount to be immediately assumed by the head company. So the current tax liability initially recognized is moved to the head company. The same with deferred tax asset for losses and credit. Initially, the subsidiary will recognize it in its balance sheet, but then instead it needs to be moved to the head company, as it is immediately assumed by the head company because under the tax consolidation rules, the tax losses flow immediately to the head company of the tax consolidated group. The only balance that stays in the subsidiary entity is the deferred tax asset and liability on its balance sheet items, its temporary differences, because the balance sheet belongs to the subsidiary member. Now, the question then is, your subsidiary has a current tax liability sitting on its balance sheet. It needs to debit that current tax liability to zero. The question then is, what does it need to credit? So the answer is, if you have a tax funding agreement in place, then the credit goes against the intercompany loan account. If you don't have a tax funding agreement in place, then the credit goes to the share capital account, a fictitious equity account. In relation to deferred tax assets on losses and credits, the other side of the entry is a dividend payment. So that confuses the accounting, and therefore we strongly recommend that when you enter into a tax consolidation regime, to put in place a tax funding agreement. So when you perform the tax calculation for members of your group, UIG 1052 provides 3 examples of the approach which you can take. So the first one is the standalone taxpayer approach, which requires you to assume that the subsidiary is not part of the tax consolidated group. And therefore, what that means is that if there's a sale transaction to another member of the tax consolidated group, that sale is tax affected. A variation of that is a separate taxpayer within the group approach. And basically what that says is, yes, do your calculation as though you're not part of the tax consolidated group, but you do recognize that transactions with members of the group are not for tax purposes. So if you have a sale to another member of the group, you can ignore that sale. That is not tax, that sale. Our preference is to use the standalone taxpayer approach. Therefore, your tax expense more accurately reflect the economic position of that entity. The final group allocation approach is to allocate the balances in a fair and reasonable manner, and really you have to use 1 or 2 approach at the top, which we discussed. Okay, so let's look at a simple example. Firstly, assume that head company does not have anything, no P&L within it. It is a simple dormant holding company. The subsidiary has land and building worth 10 million. And let's say accounting depreciation is 2 million and tax depreciation is 3 million. So accounting depreciation is less than tax depreciation. So this will reverse as more taxes in the future. So you have a deferred tax liability as a result of that. The profit of the subsidiary is 100,000. Okay, again, assume the head company has nothing in it. So what you need to do is firstly calculate your statement of taxable income. You start with a profit of 100,000, accounting depreciation of 2 million, and tax depreciation of 3 million. So tax is more than accounting, and therefore there will be a DTL on this entry. We have a taxable loss of 900,000. And let's say the subsidiary assesses that it can recognize the losses and records a DTA of 270,000. So the journal entries that the subco will need to post is to recognize the deferred tax liability on the plant and equipment. So the DTL is 300,000, paying 30% of the 1 million difference between accounting and tax depreciation. So the entry is to credit deferred tax liability and debit deferred tax expense of 300,000. The subsidiary also has a tax loss and recognize the deferred tax asset of 270,000. So you recall there's a tax loss of 900,000. The 30% of that is 270,000. So the journal entry is to debit deferred tax asset by 270,000 and credit deferred tax expense by 270,000. Okay. Now, I note here that if the subsidiary assesses that it's not probable that you'll use those losses, then it would not recognize any deferred tax asset and there'll be nothing to be assumed by the head company. Now, as a subsidiary has recognized a deferred tax asset on the losses, it is immediately assumed by the head company. So it credits the deferred tax asset account by 270,000, and assuming that a tax funding agreement is in place, it would debit the intercompany loan by 270,000. The head company has assumed the deferred tax asset, so it needs to debit the deferred tax asset by 270,000. The credit entry is to credit the intercompany loan with the subsidiary company by 270,000. Okay, finally, we'll talk about the requirement to account for uncertain tax treatments. So the relevant pronouncement is AASB Interpretation 23, which requires companies to recognize any uncertainty in any tax treatments. So it applies from 1 January 2019. And when you work out whether or not something is uncertain, you need to assume that that treatment will be audited by the tax office, and they know everything you know, have all the documents which you have. So to work out whether or not you need to recognize any uncertainty into your financial statements, you need to ask, is it probable? Again, there's more than 50% chance that the ATO will reject your position. So most people would say that, look, it's really, there's no way I will recognize anything that the ATO would reject, will probably reject. You know, if there is uncertainty, it's most likely I'll get a private binding ruling if required. But let's say you have recognized a position where there's more than a 50% chance that which you have assessed that the ATO would reject. Then you need to calculate that uncertainty and recognize it into your financial statements. So there's a two approach to that. One is the single most likely amount that you'll settle with the ATO, or you can take an average of expected outcomes and recognize that into your financial statements. So each year you need to assess that position and recognize any changes as a result of the reassessment. Okay, so if you have recognized any uncertainty in your financial statements, then it's likely to create volatility in your tax expense number. It's also going to impact your effective tax rate as well. So it's more likely if you for accountants, if you're unsure whether or not this treatment is uncertain, you probably need to work with your tax team or your legal advisors, or seek a private binding ruling from the ATO to remove that uncertainty. So it probably would be an increased use of private binding rulings for those treatments where it's really unclear or not. It's very unclear whether or not the ATO would reject that position. So that is all I wanted to cover this morning. As a recap, we spoke about some of the tax changes to consider when performing your tax effect accounting calculations. We look at the tax effect accounting concepts, and we looked at more complex accounting treatments that are required under the AASB 112. So if you require any assistance, please feel free to reach out to your SW relationship partner or managers. So we'll now check if there are any questions. We got 5 minutes for any questions, if anyone have any questions. I've got a question from Lee Swan. Do you see any future changes to the ACA allocation going forward regarding tax consolidations? There have certainly been changes over the years in relation to how we do calculate the ACA amount. including dealings with future deductional amounts and WIP balances. I'm not aware of any changes that has been announced at the moment in relation to ACA calculations. And one thing to note is that when you do perform your tax effect calculations, you take into account tax legislation which have been substantially enacted. So probably something that has received royal assent rather than something that has been announced. Okay, so I might give you back your morning. Thank you again for joining us. We'll share with you the slides and give us a couple of days to publish the video and reach out to your relationship partner or manager if you require a link to that video. So thank you very much and have a great morning, everyone.